The three-day meeting of the Reserve Bank of India's Monetary Policy Committee is scheduled to begin today, and the bi-monthly policy review will be announced on February 9th. Market participants have said that the huge borrowing program announced by the government in the Union Budget may prompt the central bank to hike the reverse repo rate. The government announced a gross borrowing of Rs 14.1 trillion for the next financial year. Let us understand why the RBI may go for a hike in the reverse repo rate and not the repo rate. The RBI adopted an ultra-loose monetary policy after the pandemic broke out. In order to inject liquidity into the system to spur growth, it slashed the repo rate to a record low of 4%. The rate has been held at that level since May 2020. Repo rate is the rate the RBI charges when it lends money to banks for the short term. A cut in the repo rate results in commercial banks lowering interest rates, in turn encouraging businesses to borrow at low rates. At the same time, what depositors receive on their savings and fixed deposits would also fall. This is meant to motivate the public to increase consumption. Meanwhile, the reverse repo rate is the rate that the RBI pays banks when they park their excess liquidity with it. The rate has remained unchanged at 3.35% since May 2020, after a sharp reduction of 155 basis points that year. The lower reverse repo rate acts as a disincentive for banks to keep their surplus money with RBI, pushing them to give out loans. During normal times, the gap between the two key rates, which is also known as the policy corridor, is 25 basis points. This gap was widened by the central bank to 65 basis points after the onset of the COVID-19 pandemic. The RBI is widely expected to start policy rate normalization and bring down the gap back to 25 basis points. It is looking to absorb the excess liquidity in the market as concerns over the Omicron variant wane. India's daily COVID cases have fallen from a high of 3.48 lakh on January 21st to 1.49 lakh on Friday. The move will also rein in inflationary pressures in the economy. Retail inflation, which is the yardstick for the RBI policy making, hit a 5-month high of 5.59% in December. The central bank has a target of 4% inflation, with a variation of 2% on both sides. Global cues will also influence RBI's decisions. The Bank of England on Thursday raised interest rates by 0.25 percentage point to 0.5% to contain spiraling inflation, while the US Federal Reserve signaled a first rate hike in March. Most analysts expect the RBI to hike reverse repo rate by as much as 40 basis points on Wednesday before starting to raise the repo rate from April. RBI's normalization drive will, however, lead to higher interest rates in the economy. Banks will pass on any hike in the repo rate by increasing interest rates on loans. On the back of RBI's accommodative monetary policy, home loan rates had fallen to multi-year lows in the past 2 years, with some leading lenders offering home loans starting at 6.75%. As most home loan rates are linked to the repo rate, they will see an uptick as the RBI benchmark rate is hiked.
See, the RBI's policy is going to come just after the budget. So I think the RBI will have to take important call, especially on GDP growth. The reason I say this is that all this while the RBI has maintained that growth is not yet durable. And that is why, even though inflation has been on the higher side, it has taken a call that we need to maintain an accommodative stance to ensure that industry is able to grow and the GDP growth becomes more stable. Now, the interesting thing is that if we go by the economic survey as well as the budget, I think they're really quite gung-ho about growth. And we're talking of growth in the region of around 8 to 8.5%. Now, again, it's just kind of a background. I think the primary challenge for the RBI is to actually decide whether it feels or it believes that the growth is durable or whether it is stable. Because that's going to be the starting point, because subsequently we all know that inflation will continue to be in the region of 5.5%, primarily on account of the fact that crude oil prices are remaining high, and it's unlikely to come down anytime soon, and the inflation threat is very much there. The budget has not made any provision to lower the excise duty in order to bring down prices in case prices do escalate. So therefore, that is a call which the RBI has to take. So under this situation, I believe that the RBI will also have to look at the excess liquidity liquidity which is there. It's already spoken of progressive move towards normalization. It hasn't taken any steps so far, but so far the measures have been that you have more of these variable reverse repo auctions to take out the liquidity, but it doesn't take out the liquidity from the system. It just gives you a higher rate of 3.99% instead of 3.35%. So I think the first step of the RBI will be to increase the reverse repo rate, and we are looking at a 25 basis points increase in the reverse repo rate. They may do nothing on the repo rate right now, but I think some kind of signaling will be provided by the RBI about how it intends to tackle liquidity and how it's going to look at inflation going ahead. So the numbers may not change, the forecast for this year may not change, but definitely for the first quarter of next year, we could be expecting some kind of upward revision in the inflation rate. And that could be the clue which could be provided as to what the RBI could do in the coming policies, that is in the new financial year. But for now, it will be reverse repo rate going up by 25 basis points, no change in the repo rate, and probably the maintenance of an accommodative stance.
Following the union budget, the yield on the 10-year government bond jumped to 6.92%. This means the government is borrowing at a higher cost compared to some home buyers, and this situation is not expected to last long.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.